If the Fed cuts rates, will Bitcoin automatically go up? It's easy to think so, but the Nasdaq, a leader in risk assets, has a history of crashing during past rate cut periods. This happened during the 2001 dot-com bubble and the 2008 financial crisis. A rate cut can actually be a signal for a decline, but 2025 is different. It's because a single game changer has emerged that will make all past data obsolete. Hello, everyone. Today, we're going to do a very deep dive into how the US Federal Reserve's monetary easing cycle, simply put, rate cuts, will affect the price of Bitcoin. Theoretically, rate cuts should be a massive tailwind for Bitcoin. However, if we look coldly at historical data, the correlation is very weak, and sometimes it even shows results that contradict our intuition. In today's video, we will analyze in depth why this discrepancy occurs, and most importantly, how the Bitcoin spot ETF, which appeared in 2024, is fundamentally changing this entire equation. If you watch this video to the end, your perspective on the market will completely change, moving beyond the simple one-dimensional idea that if rates go down, prices go up. First, let's cover the textbook scenario. Why does a central bank cut rates? It's to stimulate consumption and investment by lowering the cost of borrowing when the economy is slowing down or seems to be heading into a recession. This action has a clear impact on traditional asset markets. It's good for the stock market because companies can borrow money at cheaper rates to invest. Since new bonds are issued at lower rates, the price of existing older bonds with higher rates goes up. It also stimulates demand for real estate as mortgage rates get cheaper. Conversely, the value of the dollar tends to weaken because the return on dollar-denominated assets decreases. This is the general principle we all know. This environment is expected to be a powerful bullish factor for Bitcoin as well. There are 5 main pathways. First, risk on sentiment strengthens. When bank interest is less than 1%, people move their money to riskier assets like stocks or Bitcoin in search of higher returns. Second, the weaker dollar effect. Rate cuts usually weaken the dollar's value, which has the relative effect of increasing the price of Bitcoin, as it is priced in dollars. Third, reduced opportunity cost of holding. Bitcoin is an asset that provides no interest or dividends. When rates are high, there's less reason to hold Bitcoin instead of interest-bearing government bonds. But when rates approach zero, that opportunity cost disappears. It's a similar principle to gold. Fourth, expansion of market liquidity. Rate cuts supply money or liquidity to the entire system. Historically, the global money supply, or M2 growth, has shown a strong positive correlation with the price of Bitcoin. Fifth, low-cost leverage. When rates are cheap, the cost of leveraged investments like futures or margin trading decreases, which can further amplify buying pressure in an uptrend. Theoretically, it's perfect. If these 5 factors work together, Bitcoin should experience a powerful rally. However, this is where we must find our first crucial insight. It's the why behind the rate cuts. The Fed doesn't cut rates because the economy is doing great. It cuts rates to prevent a slowdown or recession. In other words, it's a signal that the economy is sick. What if the market perceives this not as a preventative measure for a mild cold, but as a signal of a severe crisis, like a cancer diagnosis? The fear that the economy is broken could overwhelm the positive factor of liquidity being pumped into the market. This means a rate cut could actually be the trigger for a crash. Past data proves this terrifying truth. When the dot-com bubble burst in 2000, the Fed aggressively cut its key interest rate 11 times in 1 year, from January to December of 2001, dropping it from 6.5% all the way down to 1.75% to prevent a recession. And what was the result? The Nasdaq index didn't stop falling. After its peak in March 2000, it continued to fall throughout 2001 when the cuts began, eventually crashing to 1,139 points by October 2002. The liquidity supplied by the rate cuts was not enough to stop the burst bubble and the resulting economic shock. It was even worse during the 2007 global financial crisis. When the subprime mortgage crisis hit, the Fed began cutting rates in September 2007 and lowered them to virtually zero by December 2008. But again, the Nasdaq index plummeted over 55% from its October 2007 peak to its low in March 2009. These two cases clearly show that if the reason for the rate cut is a systemic collapse of the economy itself, supplying liquidity cannot prevent asset prices from falling. The formula rate cut equals rally did not hold true. So, what about Bitcoin? Bitcoin's history is relatively short, so we have limited data. What's interesting is the period from 2015 to 2018. This was a tightening period, when the Fed ended zero interest rate policy and was raising rates to normalize monetary policy. But what did Bitcoin do? It went on a historic rally, hitting nearly $20,000 by the end of 2017. It moved completely independently of the macroeconomy, driven by internal market factors like the ICO boom and speculative demand. And then, in 2018, it crashed by over 80%, entering the crypto winter. During this time, Bitcoin was still a small independent market, more affected by its own internal factors than by macroeconomic liquidity. But in 2020, everything changed. In response to the external shock of the COVID-19 pandemic, the Fed conducted an emergency cut, rates back to zero in March 2020, and unleashed an enormous quantitative easing program. They flooded the market with massive amounts of liquidity. This time, the situation was different from 2001 or 2008. The economic system wasn't broken. This was artificial respiration to save an economy that had been forced to stop by an external shock. We all know the result. This massive liquidity became the driving force for a historic rally in both Bitcoin and the Nasdaq. It was precisely from this moment that the correlation between Bitcoin and the stock market, especially the tech-heavy Nasdaq index, became clearly visible. And in 2022, when the Fed began aggressive rate hikes to fight inflation, liquidity dried up, and Bitcoin and the Nasdaq crashed together, almost like reflections in a mirror. Okay, through these past cases, we've found an important pattern. Bitcoin has started to correlate with the macroeconomy. This is the second key insight of today's video. Bitcoin's identity in the market is changing. We have often called Bitcoin digital gold. The narrative was that its fixed supply would make it a hedge against inflation and the devaluation of fiat currency. But recent market movements raise strong doubts about this narrative. Let's look at the data. Recently, while the price of gold hit all-time highs on expectations of rate cuts, Bitcoin was actually stagnant or falling. Even looking at quantitative data, the correlation coefficient between Bitcoin and gold has been on a steady decline, at one point dropping as low as negative 0.58. Other data shows it recently recovered slightly, but remained at just 0.72. This means the two assets are increasingly trending in different directions. The digital gold narrative is, at least in the current market, losing its power. On the other hand, its correlation with the US stock market has strengthened dramatically. This phenomenon became even more pronounced after the 2020 pandemic. According to recent data, the correlation coefficient between Bitcoin and the S&P 500 index rose to 0.87, and with the Nasdaq composite, it reached 0.86. Since a coefficient of 1 means they move perfectly in sync, 0.86 and 0.87 mean they are moving almost identically. This clearly shows that the market is treating Bitcoin less like gold, a safe haven asset, and more like a high-growth tech stock, a high-risk, high-return asset. In other words, it's now perceived as an asset that rises when risk appetite is high and falls when risk-off sentiment spreads. Why did this identity shift happen? Is it just because investors' perceptions changed? This brings us to the third key insight of today's video. It's because the marginal buyer, the new money entering the market, has changed. Before 2020, the Bitcoin market was led by retail investors and crypto-native funds who were drawn to the digital gold or alternative to sovereign currency narratives. But after the pandemic, and especially since the launch of the spot ETFs, the source of new capital flowing into the market has shifted to traditional financial institutions. Portfolio managers on Wall Street don't classify Bitcoin as a gold replacement to store in a vault. They classify it as a high-growth alternative asset or a tech asset that will boost portfolio returns. As a result, Bitcoin ends up in the same risk management bucket as high beta tech stocks on the Nasdaq. Therefore, when their risk models dictate a reduction in high-risk asset exposure, a capital flow occurs where they mechanically sell Nasdaq futures and Bitcoin ETFs at the same time. It is this asset classification by institutional investors that is the fundamental force creating the high correlation with the stock market that we observe in the data. Now, we are ready to forecast the 2025 rate cut cycle. All the past data we've analysed, the crashes in 2001 and 2008, the standalone rally in 2017, the reason all this past data may become meaningless in 2025 is because of the massive game changer known as the Bitcoin Spot ETF. With the launch of spot ETFs in the US in January 2024, investors can now access Bitcoin easily, cheaply, and in a regulated environment through their existing brokerage accounts. Why is this so important? First, look at the scale. Since the ETF launch, an unprecedented amount of capital has flowed into the market. In just a few months after launch, net inflows reached tens of billions of dollars, and as of October 2025, cumulative net inflows have surpassed $61 billion. That's over 80 trillion won. Some days, net inflows exceeded $880 million in a single day, proving that a pathway has opened for an enormous amount of capital to enter the market. This was unimaginable in the past. This is the fourth, final, and most important insight of today's video. The spot ETF is not just an investment product, it acts as a new monetary policy transmission mechanism, a pipeline that delivers the Fed's monetary policy directly to the Bitcoin market. Think about the 2019 rate cut cycle. Back then, if a portfolio manager at an institution wanted to invest in Bitcoin after seeing the Fed's easing, they had to use the futures market or crypto exchanges, which had high transaction costs, regulatory uncertainty, and limited access. The friction cost was incredibly high. But in the upcoming rate cut cycle, what will that same manager do? They will simply type the ETF ticker, like IBIT or FBTC, into their Bloomberg terminal or existing brokerage account and click once. The friction cost is virtually zero. What this means is this. When the Fed injects liquidity into the market via rate cuts, that liquidity can now hit the Bitcoin market more efficiently, more quickly, and more directly than ever before. This is the most powerful and structural reason why the old data from 2001 and 2008, when markets crashed despite rate cuts, may no longer be valid in 2025. So, based on this new environment, let's make a specific forecast for 2025 and 2026. Of course, the Fed's policy will change based on the data, but we need to look at the current financial market consensus. If you look at the CME FedWatch tool or Fed Funds futures market data, the market is pricing in a very high probability, over 90%, that rate cuts will begin in the second half of 2025. Wall Street's forecasts are mixed. Bank of America predicts one cautious cut within 2025, while Goldman Sachs and Morgan Stanley are forecasting two cuts, one in October and one in December. We will proceed with our analysis under the assumption that this market consensus, a soft landing scenario where the economy stabilizes without a severe recession, becomes reality, with two gradual rate cuts in the second half of 2025. In this scenario, how will Bitcoin's price move? First, the positive factors or upward pressure. Two rate cuts will be the most important tailwind, supplying liquidity to the market and improving investor sentiment for risk assets. Bitcoin will benefit directly from this, especially now that it's correlated with the Nasdaq. And this liquidity, unlike in the past, will flow directly and amplified into the Bitcoin market through the efficient spot ETF pipeline. However, there are also factors limiting the upside. First, priced-in expectations. The market has already accepted the second half 2025 rate cuts as a fact and has priced a significant portion of it in. Therefore, the actual rate cut announcement could become a sell the news event, providing a trigger for a short-term correction. Second, the limitation of the soft landing scenario itself. This scenario is not the massive liquidity party we saw during the 2020 pandemic. Because it's not a severe crisis, it implies gradual and limited monetary easing. The scale of the liquidity supply itself is different from 2020. In conclusion, the 2 rate cuts in the second half of 2025 will provide clear positive momentum for Bitcoin's price. The existence of the spot ETF in particular is the key variable that will make this momentum stronger than in the past. However, considering that expectations are already priced in and that this is not aggressive quantitative easing, it is more likely to show a steady upward trend in line with the Nasdaq, rather than an explosive rally like in 2020. So, what indicators should we, as investors, be monitoring closely? You only need to remember 3 things. First, obviously, inflation data. If data like the Consumer Price Index, CPI, or Personal Consumption Expenditures, PCE, starts to spike again, our entire basic premise of 2 rate cuts could be shaken. This is the most important variable to watch. Second, spot ETF fund flows. This data directly shows whether the liquidity unleashed by the rate cuts is actually flowing into the Bitcoin market. It's useless if the Fed is printing money, but money is continuously flowing out of the ETFs. Consistent net inflows support the bullish outlook. Third, the correlation with the Nasdaq. We must observe if Bitcoin continues to behave as a risk asset. That is, if it continues to move with the Nasdaq. If this correlation breaks, it could be a sign that the market narrative is undergoing another significant change. Here is today's conclusion. The relationship between the Fed's rate cuts and the price of Bitcoin is defined by the tension between a strong bullish theory and a weak empirical history. And in the upcoming rate cut cycle, how this tension resolves will very likely be determined by this new market structure created by the spot ETF. Therefore, investors should not treat the Fed's upcoming rate cuts as a simple, automatic buy signal for Bitcoin. We must never forget the painful lessons of 2001 and 2008. Instead, rate cuts should be understood as a powerful tailwind that enables the key demand driver, institutional capital inflow through spot ETFs. Ultimately, the scale and speed of Bitcoin's price appreciation will not depend on the Fed's announcement itself, but on how strongly institutional investors react via the ETF pipeline to the increased market liquidity that results from it. That is all we have prepared for today. I hope this was helpful in understanding the complex relationship between the Fed's monetary policy and Bitcoin, as well as the structural changes the spot ETF will bring. If you found this video informative, please subscribe, like, and turn on notifications. I will return next time with another deep, data-driven analysis. Thank you for watching.